The objectives that Patrick and I have today is we want to talk with you about the various stages of financing. We want to talk with you within those stages of financing, what types of financing are out there, and then we want to get into more detail. I will be talking more about the government financing programs. Patrick will be talking about the alternative financing programs that his firm offers, and then we'll have a Q&A and hopefully answer all your questions that you have for us today. In terms of stages of financing, stage one startup. Is there anybody at that stage just getting going with their business, less than maybe a year or two old? Got a couple there. There's a phrase out there that startup financing, there are the 3 F's with startup financing: family, friends, and fools. So we'll see. But basically, startup financing, it's going to be tough to get. We generally don't do a lot of startup financing projects at the Wisconsin Economic Development Corporation. Banks are not exactly friendly to startup organizations because we're all looking for some proof of the concept that you're looking to start up. So that's where the family, friends, and fools comes into play. In stage 2, growth, that's where the programs that we have, the programs that Patrick has, and conventional commercial financial institution lending comes into play. And stage 3, maturity, in addition to bank financing, the alternative forms of financing, our financing. If you're looking to grow and really ratchet up your business, maybe venture capital might come into play there as well. So again, there's multiple sources of financing. We're not going to cover them all this morning, but maybe through questions we can delve into more of them. What types of financing are out there? Debt, I think, is probably the one we're most familiar with. We go to a lending institution, we go to an organization like Patrick, we go to the WDC, and we borrow money for X number of years at X% interest rate. Equity is another form. We're looking for people to put cash into the company in exchange for ownership of that company. A third type of financing is hybrid. What I mean by that is that it may initially be a form of debt financing, but over a period of time that debt financing may convert into equity upon proof of the concept and the growth of the business. Other types of financing, we do have a number of programs that involve loan guarantees. Basically what a loan guarantee is an incentive to another organization that's lending money to make the loan. They may not be quite comfortable with the financials that a company has, but we'll come in and do a loan guarantee, and I'll talk about that program. Tax credits is something the state of Wisconsin offers, and it's exactly what it means. It's a credit against your Wisconsin income tax liability. And last, the magic word, grants, which everyone here wants because it's free money. And while we do have a couple of grant programs, I don't want you walking out of here today saying there's lots of grants out there, because realistically there aren't. The loans, the tax credit programs are going to be your predominantly the types of funding that you're going to be looking at. Government can provide multiple forms of financing. Again, we have debt. There are loan programs, and I'll talk a little bit more about that specifically. We can do equity in some cases. We are looking at right now with our entrepreneurship and innovation division, and possibly being able to take advantage of doing kind of a hybrid financing, originally doing a loan and converting it to equity at some point. Loan guarantees, again, looking to basically give another lending institution the comfort that a program will do. Tax credits, talked about those, grants. The expectations at the government level with all the government programs is there must be a project. We're looking for a company who is looking to invest, making capital expenditures, and we're also looking for a company who is going to grow, creating employment. Those are the 2 goals of most government financing programs. At the Wisconsin Economic Development Corporation, our Business Opportunity Loan Fund is the debt instrument that I talked about. That program is a 5 to 7 year term, 2% interest rate, but if a company can demonstrate a need for a longer term, a lower interest rate, deferment of payment of principal and interest for a period of time, we are open to those discussions. We also offer through the Business Opportunity Loan Fund a loan guarantee, which I talked about earlier. Our Economic Development Tax Credit Program, again, is tax credits against your Wisconsin income tax liability. If you are in the manufacturing sector or in the agricultural sector, be aware that in the state of Wisconsin, we passed legislation starting with tax year 2013 that is reducing the income tax for manufacturing and agriculture-based companies from about 7.4% down to 0.5% through 2017. So basically, by 2017, you'll be paying almost nothing in Wisconsin income tax liability. Jobs tax credit is a tax credit program that, regardless of whether or not you have Wisconsin income tax liability, we provide you with a tax credit. So even if you don't have the credits, you're still going to get a check from the state of Wisconsin. Again, looking at capital expenditures being made and job creation being part of the project. Qualified new business venture. That's in our entrepreneurship and innovation division, and basically this is an incentive to equity partners to get involved in startup or young stage 1, possibly stage 2 companies. What it is a 25% credit on the investment that an individual makes in another company. So in that first year, you're already making a 25% return on that investment. And again, that's critical to getting that income, that investment at an early stage. Technology development loans, whereas the Business Opportunity Loan Fund is more broad-based, the Technology Development Loan Fund is if you have a really unique process or product, something that's new to the marketplace, something that's taking advantage of new technology, it's very innovative. We can do a Technology Development Loan Fund. In terms of stage 1 is what we're looking at there. There are other programs available at inwisconsin.com, and I encourage you to take a look at our website to see the various programs that we have available. And again, always feel free to contact me with questions you might have. Some of the other agencies that are out there, the Wisconsin Housing and Economic Development Authority, you may have heard in the paper that the governor has proposed the WDC and WHEDA may merge over this year. I'm personally excited about that. They have a number of really great programs, including their participation lending program. They also have some startup or stage 3 actually in terms of companies looking for outside equity with the Venture Debt Fund and Wisconsin Equity Investment Fund. So it's really going to allow us, I think, to provide a better range of services to our business clients across the state. So I'm excited about that. Small Business Administration, if you haven't heard about them, I'm sure you will. Small Business Administration works in partnership with a commercial lender to provide a portion of the financing package. Typically what you hear, particularly with the 504 program, is what they call a 50-40-10. And that basically means that they're looking for a bank or commercial lender to provide 50% of the financing for a project. SBA will come in with 40% of the project. They're looking for 10% equity. And if you try getting a loan lately, you know that the 10% equity requirement is extremely low, especially over the last couple of years. The 7(a) loan program, again, there can help to fund the purchase of assets. It's a working capital. It can do a line of credit. You can do a refinancing of existing debt of it. Very, very flexible program, whereas the 504 loan program is focused exclusively on assets, real estate, machinery, and equipment. Wisconsin Business Development is somewhat like the Wisconsin Economic Development Corporation. That is a private, not-for-profit organization, but it focuses exclusively on packaging small business loan products, administration loan products to companies throughout the state of Wisconsin. So they are a very good resource. USDA Rural Development has a number of programs. In terms of direct lending, they do business and industry guaranteed loan programs, again, helping to convince a private sector lender to do a deal that otherwise they may not. And indirect, and what I mean by indirect is these funds through the Intermediary Lending Program and through the Rural Business Enterprise Grant, Rural Economic Development Loans and Grants. That funding would come through either a community, a utility, a local economic development organization, rather than directly from USDA to the business. But a good source of money, in particular if you're located in a rural area. In this area, anything outside of Green Bay is going to be considered a rural area. At the local level, there are revolving loan funds, and these are funds that communities either have funded through own revenue or have gotten grants from the state or federal level for projects in their communities and have been allowed to keep that money and lend it out to businesses in their community. As with the WDC, they too are looking for job creation capital expenditures, and the amount that they will lend through revolving loan fund is typically based on the number of jobs created. They are not going to be a primary lending source. Again, there needs to be conventional lending in front, and the secondary lending is in the revolving loan fund area. Patrick?
Thanks, John, for going through the available options that are out there, particularly through the government funding and programs. As we look at those programs, there's a wide variety, and a few things that we notice right away about them is that they're especially attractive if a few things aren't true. And for starters, if your business is involved in a project and you're looking for funding, these programs are a pretty good option. So if you're building a facility, buying a machine, if it's project-based, these programs are a pretty good option. The second thing is, if you can document that you're either creating jobs or retaining jobs, again, government programs are a pretty nice option. And then, as John mentioned, if you already have a lender involved or a bank involved, those government programs are pretty nice options. So if you're sitting back and you're saying, okay, I'm trying to understand all this, one of the questions that at times will come up, more often than not, is this: what if my business needs simple working capital financing or just a short-term loan? And the answer to that really is alternative finance and companies like SLK Finance. And that's what we'll go through today. Now, if we're trying to understand alternative finance companies, we'll look at a few things that alternative finance provides. First thing is bank-like offerings. I'll go through these on the next slide, but the interesting thing you'll see is that a lot of the offerings that we have are very similar to those that are offered by banks. You'll also see that there are a few that are really unique, and they give us some nice tools to work with. But that's one of the things you'll notice, bank-like offerings. Shorter terms. When you look at government programs, the ones that John talked about, it's not unusual for the terms to be 4 years or 6 years, 10 years, 15 years. They're longer terms. Essentially what we provide in alternative finance is shorter terms. We're trying to get you through a working capital crunch or some type of event in your business, so the terms are naturally shorter. A big difference in what we do at SLK Finance is going to be your direct interaction with our evaluation team. It's a close approach where you're going to have a connection with our team. You may even have an opportunity to meet with the team and talk about your particular business situation. That's a very different thing in the lending world. When we go through underwriting, we don't send it out anywhere, we do it internally. So all the analysis is done internally, and that's a big difference. Because we develop that closeness, and because you'll be interacting with our team, one of the natural things that comes out of that, fast turnaround. Okay, you deal directly with us, we turn things around fast. That's not only turning around decisions and the way we run through our process, but also turning around our loans and our products a lot faster also. And again, coming out of that direct interaction and the connection that you'll have with us is that you're going to naturally be guided through the finance process. Okay? It's in part the way we support our lending. Okay? The valuable thing about that is you're going to pick up some things and you're going to learn a little bit about financing, and that should have a short-term value, of course, and then also a long-term value, because you're going to take that with you as you develop your business and it grows and you get into a big banking relationship someday. You're going to be able to take these things with you. So some primary differences in what we do. Now, I mentioned the offerings, and I want to go through these. Starting with the line of credit. Now, we all understand what the line of credit is, a pretty common offering at banks. I want to point out a few things that are advantageous about this, of course. They're flexible. We get a certain amount of flexibility with a line of credit. We get a certain amount of freedom. And because we have the freedom to pay down that balance, they're a little bit cost effective too, so we have some control over the cost. Simple short-term loans. I love the short-term loans because they are simple, they're easy to understand. There's an added benefit if we get an arrangement where you have a short-term note, where you're making only interest payments each month. That can have a great benefit to your cash flow. So although they're simple, they have some great benefits also. Now this is a unique one, and this is One of them that I wanted to talk to you about this morning, and this is contract or purchase order financing. Unique because this can offer a great boost to working capital. Essentially the way this works is that we'll take a purchase order, a large purchase order, or a group of purchase orders, and we're going to allow you to use those purchase orders as collateral. And we're going to be able to lend to you based on that collateral in those purchase orders, based on the value of the purchase orders. What's really nice about this is that it's very scalable with your business. So as you start to grow, it's not uncommon that you start to take in lots of orders, loving the success of your business, and you run out of working capital. This is a great way to create working capital as your business grows. And this is a little bit unique. Probably don't find this at a bank. The last one is receivables factoring. This is fairly common these days. I can tell you that there's a whole commercial industry out there that's built on receivables factoring. We do some of this at SLK Finance. The reason this is valuable, a few different reasons. And if you haven't familiarized yourself with receivables factoring, it's fairly simple. Once you invoice your customer and you have a block of invoices or a particularly large invoice, we take those invoices, and it's actually a purchase arrangement where we'll purchase those invoices. And when we purchase the invoices, what we're able to do is advance you funds. Where this is a huge benefit for a lot of businesses is where your customers are paying you in 45 days, 60 days, 90 days, or beyond. By extracting the value out of that and then advancing you the funds once the purchase is done, again, helps you with working capital because a lot of your capital is sitting out in those invoices when you're waiting for payment, and that can be a big boost. The other big advantage to this is off-balance sheet financing. This is considered an off-balance sheet form of financing, and what I mean by that is that when we go through that program and we purchase the invoices, that transaction is not listed as a liability on your balance sheet, and for a lot of businesses that can be a big advantage. Okay, so some similar products and some different ones. Now, I also wanted to run through quickly what our process is for lending, because it varies from what you see out there, and if you have any banking experience, you'll notice that it's different right away. The underlying themes in this process are really simplicity and speed, and I'll probably say that again at the end, because that's what we built this around. Assessment. A simple first step for us. What we want to do is learn as much as we can about your business. We will ask you for financial information. All lenders will. But I can tell you that our understanding of your business is going to go deeper and much beyond just the financials. In most businesses, there's a lot more going on than what we can look at in a balance sheet or an income statement. And we're going to want to learn what those things are. Our next step is to take all that information and we're going to evaluate it. We're going to evaluate it in that small group that I mentioned to you. That's the point where you may have more direct interaction with our team as we try to understand what it is that's going on in your business, understand what your needs are, and then try to create some solutions for you. Okay? The interesting thing about this evaluation is that after we get all of your information about your business, this evaluation typically goes on within just a few days of getting that deeper understanding of your business. So this is a pretty quick process. From there, we move on to solutions. We want to be able to propose to you at least one solution, maybe multiple solutions. This will happen within a few days of that evaluation meeting. So as you're adding up the days here, you'll see that we can usually provide financing in about 5 days or less. Sometimes it's faster. What I like to do when I'm working with clients is ask you, how fast do you need this? Because in a lot of situations, when we're talking about working capital, the need can be immediate. So underlying themes in this process, again, let's keep it simple. And there's also that underlying theme of speed in this whole thing. So process is a little bit different than what you may experience in the banking industry. Now, before we go to the questions and the discussion, I wanted to give you a little bit of background about SLK Finance. Essentially what we're here for is to provide capital solutions for growing businesses. Now, the reason that we're here, and the reason we were founded locally here in the Green Bay area, was a result of the financial crisis. The lending environment today is very different than it was 5 or 6 or 7 years ago, and you all know that because you've all been involved in trying to get financing. Our approach is really simple, our focus is really simple. It's about creating a straightforward approach to meeting the capital needs of growing businesses like yours.
All right, thank you, John and Patrick. Thank you. Will the other two gentlemen, who's the other two gentlemen who are going to come join the panel? Right now, we're just going to open it up for questions. I'm pretty sure you guys have a lot of things running through your head. I know I have a few questions myself. It's more of a greedy, personal question. It's up to you afterwards. Just being honest, we're here for money, right? So don't judge me. You guys are thinking. So is there anyone in the audience who has a question first? John?
I got a question for Patrick. Patrick, can you go a little bit more in depth on the purchase order financing versus the receivable financing?
That's a great question.
Sure. The biggest difference really between those two is going to come down to the dollars and the value that, I'm sorry, I do have kind of a big voice. The biggest difference between those two is really going to come down to the dollars and the valuation of those two things. We can use both as collateral, but it's really going to be the valuation. The valuation for the discount associated with a purchase order versus a receivable, we'll just discount it a little bit more. That's really the end result. And I'll tell you this too, it's not uncommon for us to take that purchase order, provide financing and an advance based on the purchase order, and then when that purchase order changes into a receivable, we would then grab the receivable also.
That answers it. Thank you.
Patrick, do you customarily ask for personal guarantees, or?
It's a good question, and I run up against this every time we deal with a new client. And the answer is yes. And what I also try to do is provide a little bit of background on that, in that you're going to find that almost anywhere today. It won't matter the institution that you're working with. It's become something that's very, very standard, the personal guarantees.
And how much time of performance are you looking for in doing business? How many months or years, or?
That's gonna vary. Some performance is nice. I know when businesses start up, and especially when you're in that growth phase, it can be a little bit rough. Some performance is nice. What we want to try to understand though is how your business makes money, and sometimes we take a future look too. It's because, again, when you're in a situation where you're running low on working capital, there's some things going on in your business. There isn't a set number for a number of months or years of performance though. And that's part of the deeper look that we take into your business.
Do you talk about rates?
In public? I'm joking, of course. We do talk about rates, and it's a common question.
We are recording this.
Yeah, I know. We do talk about rates, and what I can tell you is that we're not able to achieve the same rates that banks do. They obviously operate with huge economies of scale, and they have the systems in place to do that. Our rates start just above what you can probably get from a bank. What we recommend to all of our clients all the time is that eventually you need to graduate to a banking relationship. That's a healthy step in the long-term finance strategy for your business.
Chris?
What's a average size loan that you guys work with as far as how much money is lent out?
It's a range, of course. If I had to say the average today, it would probably be around 100,000. It might be lower than that, between 50 or 100,000. It ranges from about 20,000 all the way up to about 500,000. We do loans down to about 20,000 on the small side.
Patrick, I have a question for you. You mentioned a lot of different government programs that can help. As a small business owner, what resource do I have to take the right path to choose the right government program?
Call me. No, really, and I say that kiddingly, but I am a portal for you in terms of all the government programs that are out there. We have contact with the representatives of Wisconsin Housing and Economic Development Authority. I talk with the folks over at USDA/RDA over in Stevens Point. Wisconsin Business Development we're in constant communication with. So, my job is to not only find what types of programs that the WDC has that work for you, what other government programs are out there that will work for you. So, concierge service is what we're all about.
If I could piggyback on that, John's presentation of stuff that the WDC and WIDA has, I mean, he really just scratched the surface with their arsenal. I mean, the tools that they have to lend is very impressive. I mean, like you said, he can get you the rural development, USDA dollars, but there's also TIF financing that you work with municipalities. There's also revolving loan funds, there's micro loan funds, there's even, I think you guys still have your minority business and women's business development loan fund through the WDC as well. So I highly encourage, if you guys are looking at that, definitely sit down with John and talk and just see the plethora of programs that they have. I mean, even a lot of their programs, they could actually probably just stack together a couple of programs as well too, for your business as well.
So I got a question for John. John, so I've got a more mature business, and I was able to take advantage of the Technology Development Loan Fund. Now that we're going into a different area, am I eligible to look into a different loan through you?
With the Technology Development Loan Fund, there's basically 3 steps, and companies can progress through those 3 steps, or if things go extremely well and they don't need to take all 3 steps, yes, you can then approach the Economic and Community Development Division for access to the programs that are in the area that I serve. The Business Opportunity Loan Fund, the Economic Development Tax Credits, Job Tax Credits.
Thank you.
One of the things that, Pastor, you guys touched on, I think you said like short-term financing. Define short-term.
Short-term, in terms of the range that we typically provide, we help companies out with loans that are as short-term as 30 days. Again, it depends on what you're trying to get through in your business. In a lot of cases, it's just a short-term working capital crunch. Sometimes there's an event or something going on in the business. Most of our loans that we create, though, they go out to about 18 months. So anywhere between 1 month and about 18 months. But in terms of the other programs that are available, that's very short term. Also, I'll add too, it's not unusual for clients of ours to come to us, get a simple 1 or 2 or 3 month short-term loan. They go back to their business, and then something happens a year later, and they come back. That's also very common. But again, it's trying to get them through an event or some type of working capital situation.
Okay. So bankers, they're in love with this thing called a credit score. I don't get why they're so obsessed over it, but how does that play into your determination of how you guys loan money to individuals? Both of you guys, both John and Patrick.
Yeah.
As part of our underwriting process, we do take a look at credit scores, background, personal information. We do a good job of underwriting. We are dealing with, thank you, Wisconsin taxpayer money, so we want to make sure that the deals we do are good deals for the taxpayers of Wisconsin as well as for the businesses that we're financing. It is not the end all in terms of the score. Patrick talked about getting to know the client that you're dealing with, getting to understand the situation, and there is a bit of character lending evaluation that goes on as well, as much as there is with the strict credit scores.
The difference with alternative finance, so if we're talking about contract or receivables factoring, is it's actually not your credit, it's the credit of your client. So, if you're in the outdoors area and Cabela's is one of your clients, we look at it in terms of what's Cabela's credit.
Yes, sure.
My business is established as a partnership, and so the problem that I continually run into when I approach the bank to try to get a loan is they will come back and tell me that I haven't established enough credit. Well, the company came out of the blue and has nothing. So if I'm now looking for some sort of credit option, what's the best route to go to help build that score? I mean, like, does SLK report so that I can build that up, or?
Take a shot at that. One of the things we try and mix in through our process at SLK is some level of advice as we're going through assessment evaluation. You know, it's our process. So if it's one of those things that you need to be doing to get to banking is establishing credit, and that's something we're going to try and help you do. You know, we say no a lot. A lot of people say no because of the terms we come back a lot. Our take, though, is that is an okay part of the process if our no or our qualification for something like comes with some piece of advice, like let us introduce you to WDC. What you really need is equity, not debt. But you know, and there's a whole list of those types of things, and that's something we really try to weave into the way we're trying to do business. So if establishing credit is something you need to do, you know, we're going to look out with you and say, look, let's try and have you bankable at a regular bank, you know, at a regular interest rate, terms and whatnot, in 1 year, 18 months, 2 years, 6 months, whatever it might be. And then you're going to put together a little checklist, kind of work it back from that and say, what do we got to accomplish between here and now? And I don't mean to bemoan bankers, because a lot of them are great, and some banks are fine, but they're really out of that risk business. And what's been frustrating when Paul and I founded the company, and Pat helped us build it up, was a lot of times it was just no, and not no, and here's what you need to come back with, or here's someone you should talk to. It was just no, I'm sorry, we can't help you. And that didn't seem to be a very good thing for developing this area.
I'm going to ask some questions, and if they're too personal, just tell me not to ask. When you're talking with the bank, were they asking for credit ranking or rating on your business itself? Or what, I mean,
Yeah,
did they communicate with you what they were looking for in terms of their credit score? Was it on the business or on you personally with respect to the two partners?
It was for the business, and they said that we didn't have enough proof of like success or whatever, and we don't have any debts against the company, so we didn't have any credit to go off of.
Yeah, your situation is not typical in terms of a new business. Banks looked, you know, they would like to see history. They like to see 3 years of financial statements, and I'm not downgrading banks. They have an obligation to their shareholders as well. WDC to the taxpayers of the state of Wisconsin. So they are looking to have good information on which to make a loan that they're confident that the loan can be paid back. My advice is to keep shopping on banks to find one that'll lend based on your personal credit record and looking at the potential of the business. There are bankers out there that will do that.
Actually, just a response to that question, we just overcame that challenge finally. But we had that exact same challenge, and what we ended up doing was got a Dun and Bradstreet number that helped out a lot. And then from there, we started setting up accounts with our vendors we currently work with. And even if it's only $2,000, $3,000, $4,000, $5,000 line of credit with vendors, then they report, and that goes on your company's financial, well, also on your personal. But then that started getting the snowball going, and where when a bank does take a check out on your business, you have a list of, I don't know, capital availability out there. So that helped us get through that crunch for the first year or two.
I'd also suggest, again, part of the team that you need to put together as a young business, you need the banker, you need your commercial insurance company, you need an accountant. And when I say accountant, I don't mean a bookkeeper that uses QuickBooks to generate payroll. I'm talking about an accountant who can provide you with business advice.
You know, kind of capitalizing on that question, what type of documentation do you guys require, like when a company comes to you guys?
Our application form requires you to describe the project in terms of the capital expenditures, what basically sources and uses statement, if you're familiar with that term. What are the uses of the money? What are the sources of the money, with WDC being one of them. We also have an area in which you need to project what your either employment growth or employment retention will be over a 3-year period. We look at a 3-year project period in terms of eligibility for assistance. We do ask for 3 years historical financials. If we're doing a loan versus a credit, we ask for 3 years of projected financial statements. If you are if there's anyone that owns 20% or more of the company, we ask for a personal financial statement. Having said that, if there are reasons for you not wanting to supply that information, we do have an exemption process, and there are some ways we can get to getting the information that we need to make a decision on without having that type of information specifically sitting in front of us. So there are some options, and we try and work with the company to understand their situation and see how we can balance your need for lending versus our need to protect the Wisconsin taxpayer.
The list John talked about is fairly common. We like to have at least 2 years of financials if that's possible. And I say that because some of the businesses that we deal with have only been in business for a year and a half or whatever it is. So 2 years of history is great. Anything year to date in terms of financials is also helpful. If we can get something like a budget so we can understand what your performance versus your plan was for your last fiscal year, let's say, or the current fiscal year, that also helps us understand how well do you do at understanding your business and then performing to what it is you say you're going to do. So again, that's part of our trying to get that deeper understanding of your business.
John, providing the information, you mentioned that you are collecting some tax returns. Is it a public information? Does it become a public information, or?
That's a great question. I should have mentioned that. In working with the WDC, we are a private not-for-profit organization, but when we were created, we made the agreement that we would be subject to Wisconsin Open Public Records. So what does that mean to you? Until you sign the contract, any information you provide us is confidential and cannot be requested through open records. Once you sign the contract for the tax credits for the loan guarantee, our project file records then become open records. I will say that our attorneys are very good at vetting a request for open records as to why the information is needed. It can't just be a search for something. There has to be a reason for the open records request. Based on the conversations we've had with our attorneys recently, we've had maybe half a dozen requests over our 4-year history. Most of those have either been media or politicians looking for information on what the structure of a project or an award that we made was. We've never had a request from a competitor or someone simply looking to see what the financial information is for a company. But we'll do our very best to protect as much as we possibly can.
And you can block trade secrets as well. If you have a trade secret for your company, even with my background in municipal government, you can still block that out. That's something that it will go in a file, but it's something that's not public record if you have a trade secret.
Yeah, with trade secrets, particularly part of the application process and working with the regional account manager, and there are 7 of us throughout the state, we'll go through that with you and we'll identify what you can legitimately and clearly protect, such as trade secrets, just general financial information of the company. We'll do our best, but we're not going to guarantee that information couldn't be made available if someone requested it, again, after a contract is received.
Just don't do it during an election year. So, that's really
for the panel, the job tax credits, could somebody explain those a little bit further, like what type of business would be eligible for those and how they would take advantage of those?
The jobs tax credits, most of the WDC programs are focused on manufacturing companies versus retail or hospitality industries. I'll just use those 3 broad categories. The jobs tax credit program is for significant projects. What's a significant project? Probably the creation of 50 employees, capital expenditure of $2 or $3 million at the minimum. In terms of a project. The jobs tax credit, we don't have as much funding for that as for the economic development tax credits, because the jobs tax credits are paid to you regardless of whether or not you have a Wisconsin income tax liability, versus the economic development tax credit depends on you having a Wisconsin income tax liability. Briefly put, economic development tax credits will go with smaller projects. The jobs tax credit, we're looking for significant impact type projects in an area.
Would construction fall into, large construction contracts fall into that realm?
Construction in itself, no. If the company that you were doing the construction for made the application, yes. But the construction company, no.
I mean, for example, like the state of Wisconsin or the VA or the federal government, a federal project, construction project.
I'd have to look that up and get back to you on that one, because I'm not sure whether, my guess is that we're not going to fund a project for which there are federal or state tax dollars being used to pay for the project. So this would be, we would be funding private sector projects where the financing is through equity from the company owners, conventional financing through a bank or other commercial lender in our programs.
Are you talking about like construction, creating construction jobs?
Well, for a construction contract, obviously, if you pick up, let's say, a $5 million construction project, you obviously have to ramp up for that project if it's in a certain area. So it's creating jobs for that specific area, let's say Milwaukee, for example. Or an area that's like maybe northwestern Wisconsin, that's a large construction project, private sector. So either way, I was just curious.
It depends on how you define construction jobs. In some communities, they have to be defined as permanent jobs, and so there's a certain criteria that you have to go through. And many times construction jobs kind of fall into like the seasonal category, so it depends on the area I think that you're working on. But typically it's the company that you're getting hired by, they would be the ones who would make the application for that.
A nuance with the economic development tax credit program that I didn't want to get into today, but I will get into because your question lends itself to it, is that we have established a process for the transfer of the economic development programs. As I mentioned, a manufacturing company, its income tax liability is going to decrease between now and 2017, so the credits aren't worth as much. If they are doing a project, what they can do is to work with you and saying, in exchange for us transferring $200,000 or $300,000 worth of credits on a project, will you reduce your cost to the company in exchange for that? And it may not be a dollar for dollar, but you may give them a $200,000 discount for $300,000 worth of tax credits, something along those lines. So there's a possibility of, when you're involved in as the contractor, there's a chance with the project, your client would actually be the applicant, but then they can transfer the credits to you. If you have situations like that, again, just give me a call and we'll work out the details.
And since you're in like multiple areas, John, getting to know John and his counterparts, because John covers the territory for the like Bay Area Regional Planning Commission, like the Northeast area, but he's got counterparts in every aspect of the state, in every corner of the state. So if you're working in a different area and you have the same questions, wherever, you can contact John, and John can put you in touch with his counterpart in that area of the state as well too, and they can be able to provide, technical assistance or even just answer questions for you as well too. Do you have any other questions, folks in the audience? So one question I have, I'm a big fan of Shark Tank. I watch it. And it's like your company kind of, so
it means nothing to me.
I love Mr. Wonderful. I mean, I have his picture in my office. But so when you guys are talking, so do you guys look at taking like equity positions in companies or anything of that nature?
I'll speak first, and then I'm going to ask either Paul or Alex to weigh in on this also. We don't typically take equity positions, is the answer. But when we look at the area that we're involved in, you have a number of options out there. You certainly have all the programs that John is talking about. And if you can sort through those, they can be excellent. You have a banking relationship that you can start, but I know some of you have tried that already and haven't been so successful. You have private equity options too. You can go out and try and raise your own private equity. Where we fall is in the middle of all of that, where from a rate standpoint, we're going to be a little bit more expensive from a rate standpoint than a bank. However, when we look at the options of private equity, because we've already said we can't work with the bank, but when we look at the option of private equity, we cost a little bit more than a bank, but at the end of the day, you keep your business. We're not asking for a stake in your business. And that's really the benefit to what you do with us. It's short term, and we're not going to ask for that piece of your business, because when you look at the options of equity, they are very, very expensive, especially if your business is as successful as you're planning on it being. That little stake they take today, it's going to be a huge payback for whoever invests equity in your business.
So I'm going to answer the question about, maybe we're getting back to what a venture capital firm is looking for, because in most cases that's basically what Shark Tank is doing. And so a venture capitalist is basically taking an equity position in your business, and their rate of return expectation is probably 30% or more. So they're looking to 2 times the money that they put in, and maybe somewhere between like 4 and 5 years. The other thing that, from Alex and my perspective, part of the reason that we're both in venture capital funds, but the thing that's difficult is to see the business being sold. So venture capitalists, they're expecting exit. In most cases, that means your business is being sold, or hopefully it would be that you can buy it back. But again, when you buy it back, you're paying 2 or 3 times the money that they basically put in. So hopefully that's helpful.
Yeah, I'd second that. Pat touched on it. One of the pieces of advice we get from us is if we think you need equity versus a debt, an interest-bearing type instrument, that's something we're going to tell you. If you need help saying, okay, where would I go for that? That's something we can try and help facilitate. We do equity investing. At this point in time, though, SLK is strictly focused on a debt or a financing type relationship like that. And a lot of times the rates, if you were to impute them, say, an equity side, it can be equity alike. But the key is what Pat mentioned. If early on in your business, or you hit a snag and your business is struggling, but it's coming back, if you have to sell someone a piece of that business, through your hard work, you have all that success. You look back X number of years later and try and compute what your cost was of having let someone buy 10, 20, 50, whatever percent of your company to get it through. That ends up being significantly more expensive than even what might seem like a high interest rate, but that was for a targeted short period of time, with no beginning, no end, to get back to either no debt or regular bank debt and keep your business. And like I said, at the same time, if you think what you need is an equity partner, that's something we're going to suggest and facilitate that. But at this point, SLK is trying to stay focused on just business capital, working, sometimes fixed asset and whatnot, but really targeted on that.
Also, do you guys, I just thought of another question. When you talk about the businesses that you work with, is there a specific type of businesses that you guys like? Do you guys have that no sin business like clause? Like most municipalities have, they're not going to lend money for gambling, prostitution, these other vices in the community, things like that. They do, they have. So they have that sin business clause. Is that something that you guys work with, or do you guys just look at the bottom line and say, cash, cash?
We're agnostic about sin. Well, we really try and dig into who the driver of the business is and what the business is, and whether or not that business seems like a going concern, with or without more equity, with or without debt, and that's where we're going to try and take it. We try and stay out of evaluating what market is. What business it's in factors into whether or not it's bankable, if you will, or financeable, sometimes, but not on ethics screen or something.
And just to clarify, that's not why I wanted to talk to you guys after. In case my parents see this. Just to clarify that. Any other questions from the audience or anything? No? Aaron? Yes?
Would you just introduce yourself and say what your part in this? Because I know you, and you have things to offer also, advice, business advice.
My name is Quayson Shaw. I'm the Economic Development Coordinator for Northeast Wisconsin Technical College. I'm on the board for the Packers Mentor Protege program, so I just thought I would do the facilitation of this since I have a background in municipal economic development as well and done a lot of these programs that these guys are talking about. So, yeah. So with that, I'll introduce Aaron Popke.
Good morning, everyone.
Good morning.
My name's Aaron Popke. I'm the Director of Public Affairs for the Packers, and I help with our program. And I'd like to thank Anna and Evelina for everything they do in administering the program. And thank you, gentlemen, for our panel today and the facilitation of questions and answers. And for all of you taking time out of your day to participate in this. We've got some mentors and proteges here present, so appreciate your participation in the program and everyone else. Thanks for coming, and certainly would encourage you to stick around as your schedule permits to do some networking and further discussion. We've got some great items in the back if you need to fill your tummies before you take off for the rest of your day. But I guess at this point concludes our formal program, and again, feel free to stick around and do some networking.
I just have to make one announcement that Mary from SBA Milwaukee is in the audience also, just in case you would like to call on SBA.
She'll be popular here.
Because I would have added my 2 cents if I thought it was okay, but I don't know. Wait. So SBA has allowed to add, and thank you, John, very much for your comments on SBA. So, yeah, I'm here if you have questions on us.
Just the last thing I'd like to add is today we're talking about financing, but in a business structure, you have financing, marketing, and operations. And there are resources out there to also help you with marketing and operations. So today's the focus on financing, but again, people like Grace and myself are also portals to the other areas of running a business. So don't be afraid to contact us for something other than financial. If it deals with growing a business, we can help.